my intent today, I am the founder, as Harinder told you, the founder of Technology Capital Partners. We describe ourselves as investors of technology rather than investors in technology. And my objective for today is to do a couple of things. First of all, to just kind of help you understand the landscape, the investment landscape, and where this world of private equity lands in this landscape of investment options. And specifically, how does a private equity partnership work? And then I want to talk about what we're doing, which is an unconventional strategy for pursuing private equity deals while commercializing technology. And then at the end, I'm wanting to make sure that you all understand that this is a field that can and should be open to you. And I'm happy to talk about how you access it if this is of interest. So I want to fly through the beginning stuff because really the more interesting and more important stuff is towards the latter 2/3. But I just want to give you a sense for the landscape and how investment partnerships in the private equity realm work. So that said, this is an attempt to sort of give you an overview of the investment landscape. And as you'll see up at the top, we're talking about traditional stocks, domestic stocks and foreign stocks. They're typically referred to as equity. You've got all sorts of variants in that arena where you've got large cap, small cap, growth, value, all of these, different ways that you can segment the investment landscape. The purple boxes are fixed income. So those are bonds. And the green boxes are the realm that private equity resides in, specifically called alternative investments. So these are things other than stocks and bonds. So they might be real estate, they might be convertibles, they might be commodities and currencies and hedge funds and so forth. And as you'll see, this little box right here is the box that we're going to talk about today. And that is the realm of private equity. And typically, if you're an investment manager, your objective is to assemble a portfolio of uncorrelated investment assets. So you want a certain amount in stocks in the US and some in the international, some fixed income, some alternative assets. And the art of putting together investment portfolios is coming up with a mix of investments in a portfolio of uncorrelated assets that will, achieve your objectives while limiting the risk that you have to incur doing that. So in the private equity world, you've got two extremes. You've got early stage investing and you've got late stage investing. So this chart shows you the early stage investing box at the upper right and the late stage investment box at the lower left, which is typically referred to as buyouts. The early stage investors are venture capital investors. And in between is the line that you can expect to achieve a return. So if you look at the chart, you've got risk across the bottom and return to the left side. And what that basically says is the more risk you're willing to tolerate, the higher return you should expect. So this is the traditional internal rate of return expectation curve. And again, the lower the risk, the lower the return is what should be expected. I don't think I'm telling you anything you don't already know. Very quickly, in the private equity realm, whether you're a venture capitalist or a buyout shop, you operate typically in what's called a limited partnership structure. And what happens is you'll get some on the general partner side, the left-hand side here, you'll have industry experts and investment experts who will do all the work. And on the right-hand side, you've got limited partners who will put up all the money. And the deal is typical. So these people on the right, these limited partners are folks like endowments and foundations and the CalPERS, for instance, the California Public Retirement System. You've got all of these huge pools of capital that are looking to have somebody invest their money and outperform traditional public stocks and bonds. That's why you invest in alternative assets, because you think they might be somewhat more risky, but you expect them to provide a somewhat higher return. So the deal in a limited partnership is, look, the limited partners put up all the money and the general partners do all the work. And then at the end, you split the profits 80-20. So the limited partners get their money back, they get some sort of a preferred return, and then whatever's left, 20% of it goes to the general partner and 80% of that profit goes to the limited partner. And again, I don't expect, this is not, a deep dive on all these topics, but if anyone has any questions about this, I'm happy to address them later. But I just wanted to give you a landscape. You've got this landscape of investment options. One of those is private equity. There are two extremes within private equity, a venture capital early stage investing versus buyout investing, which is late stage. That in buyout investing, you buy a company that's been operating for a long time, and you buy it because you think you can make it more profitable, and then you'll sell it to somebody for a higher price than you paid for it. It's pretty simple, really, but conceptually it's simple, but how it works isn't. So Technology Capital Partners is a leveraged buyout firm. We are in the business of acquiring operating companies, and we pursue a unique strategy that we call technology-driven growth acquisitions. Now, typically, and some of you may have had experience with this, if you have some sort of technological innovation, you have a sort of a playbook about how you commercialize that technology. You might try to find a strategic partner, a big corporation who licenses your technology or acquires your technology, or you might try to raise capital from a corporation or a venture capitalist in order to build a company around yourself to commercialize the technology and capitalize upon that innovation. Now, what we do that's a little different is our philosophy is, with regard to commercializing technology, is, why build it if you can buy it? In other words, rather than raising venture capital to build a company around yourself, which, raising venture capital is a very time-consuming, risky, expensive thing to do. And building a company from scratch is another very time-consuming, risky, expensive thing to do. And so our philosophy is, let's not do that. Rather than raise venture capital to build a company that may take years, let's instead identify a company that already exists that looks a lot like what you would otherwise build, and let's acquire it. And as owners of that company, let's commercialize the technology through it. Okay. And again, I know I'm throwing a lot at you, and I'm happy to answer questions. And Harinder, did you say, I know we don't want to interrupt the presentation a lot, but if people have urgent questions, they're permitted to ask during the presentation, correct?
That's right, they can. Yeah, if you would like to maybe find the right time, just put an asterisk or a plus sign in the chat, so I know that you have a question, and I'll interrupt, and you can go ahead, unmute yourself, and ask the question directly. Otherwise, if you're feeling shy, just feel free to type in the chat, and I'll interrupt Michael and ask the question.
Great. So essentially, how we do what we do is, first we locate technology, and we have this unconventional view that under certain circumstances, technology itself is a form of capital, right? It's not a consumer of capital when the technology is fully baked. We call it immediately deployable. It's been described all sorts of different ways. It's plug and play. It's immediately deployable. It's TRL 8 or 9, whatever. What matters to us is that the developmental risk of the technology has been eliminated. And then when we find technology like that is struggling to commercialize, and maybe even dormant or languishing someplace, what we always ask ourselves is, that's such compelling technology, what could we acquire with that, based on that technology, that would enable us to control the commercialization process, because we're acquiring the company through which to do it, right? So instead of trying to convince somebody else to license our technology and then commercialize it, we're going to do it ourselves by acquiring them and infusing their product or service with this disruptive technological innovation that will give the company that we acquire an unfair advantage relative to its competitors. And therefore, we'll be able to grow our market share. We'll be able to take business from our competitors while we're actually raising prices for our product. So I'll stop there. But, recently I was having this conversation with somebody, and he said, okay, so Michael, let me see if I got this straight. He said, the company that you acquire is like the rocket on the launch pad that's just sitting there waiting for something, who knows what. And the technology is the rocket fuel that you bring to the opportunity that enables that rocket to take off. And I said, yeah, that's exactly the way to think about it. But the difference, again, is that we want to be acquirers of infrastructure rather than sellers or peddlers of technology. So here's an example. I hope it's understandable of what we do. So we're looking for a disruptive technology that's immediately deployable, and it's compelling, and it's commercially significant, and it's potentially disruptive. But as is so often the case, it's struggling to commercialize. In the early stage sort of venture community, you have a fairly low success rate. So if you're only right, and I don't mean to be disrespectful to anybody from the venture community who might be on this call, but if you're only right 10% of the time, you need to be swinging for the fences every time, right? So if in a lot of cases there's technology that the venture community, the early stage investment community has deemed will never be that huge a success. It'll never, what they call a unicorn. So they're out there constantly looking for unicorns. And yet we maintain that there's a vast quantity of technology that maybe it doesn't fit that quote unicorn description. It won't be $1 billion exit, but still it's very compelling technology that could enable us to acquire a platform company. Let's say we acquire a company doing 50 million a year in revenue, and it's sort of another company competing like everyone else in their space, and they don't have any particular advantage. That typically means that they're not growing very fast, if at all, and they're only marginally profitable. So that's the match that we're wanting to put together. The operating company, the platform company is the launch pad, and the technology is the rocket fuel. And we want to put those two things together to create this market-leading growth company that has a sustainable competitive advantage. It's going to grow very rapidly, and it's increasing its share of the market. That is what we refer to as a technology-driven growth acquisition. And if we're able to do that, these two boxes, the late stage buyout and the early stage VC, should look familiar, because those are in exactly the same place where they were on that earlier chart that I shared with you. And what we believe, and remember that dark line between those two boxes, that's the expected rate of return that you would expect as you move higher to the right in terms of accepting more risk. You should expect a higher return. Now, where we participate and what we think we're doing is by pursuing this technology-driven growth acquisition strategy, we're moving up and to the left. In other words, we're achieving a higher return for our investors while reducing the risk profile of our acquisitions. And again, I hope I'm not going to read these charts to you. I just want you to get the gist of what we're saying. We believe that we can create venture-like return at buyout-like risk. So we're creating a disconnect in the risk-reward proposition by doing deals the way we do them.
Michael, there's one question. Someone wants to know, like, if there's one or two like unique examples you could give, which are relevant, pertinent to this.
Sure, I'll give you an example. It's funny because when I went to do this originally, this strategy evolved from some work that I was doing with Bain Capital when I was at a technology incubator in Princeton. And I approached them with an idea, and they sort of turned it around on me. And this, I claim credit for this because we're out there doing it. But it was really, in truth, this was sort of Bain Capital's idea. And when I told all my Wharton friends and all my Wall Street friends what we were going to do, they all said, "Wait, you're going to use technology to buy companies?" And I said, "Uh-huh." And they said, "No, that's a stupid idea. That'll never work. Don't bother. The experts told me this would never work." And so one example of such a deal, when I did this originally, we had 4 different technologies. One was in robotics, one was in carbon composite materials, one was in internet healthcare monitoring, and one was in software in the 911 space. And the deal that we did, and this software startup was a state-of-the-art system for managing a 911 emergency. So it's basically when an operator would sit at their desk with 3 monitors, and they could point and click on emergency and EMS and fire and police vehicles and reroute them to more pressing emergencies. And so it was really state-of-the-art system software for managing a 911 emergency. And what we ended up acquiring was a company that was a spin out of Nortel. It was the only manufacturer of digital switches specifically for the 911 industry. And at the time, something called enhanced 911 was just beginning to roll out. So we had the best solution software for managing the call. And they had this young company, I think they were doing like 23 million in revenue. They had the best solution for routing the data in this rapidly increasing quantity of data that was being delivered so that you could pinpoint the location of an emergency much more efficiently than you could previously. So again, I won't belabor the details, but that was a $12 million equity investment that we then sold 5 years later to Golden Gate Capital for $85 million. So our investors made 7 times their money. Our technology accelerated its access to the market. And the company that we acquired had this, quote, what Bain Capital used to call the silver bullet that enabled them to be successful. So I'm happy to go into more detail later, but I hope that that gives you an example. So, there are a number of advantages that we believe result from this approach to commercializing technology. The first is that we're putting together legitimately proprietary deals. These operating companies that we want to acquire largely don't have any other buyers, because who wants to buy a boring business that's not growing and only marginally profitable? Maybe it's even shrinking, right? So we are interested in acquiring operating companies that are not being auctioned off by investment bankers to the highest bidder. In fact, we expect in most cases we'll be the only bidder. So that's an advantage. We align the deals with what's going on in the private equity world today, which is these private equity funds are getting so big that they can't invest $5 or $20 million at a time. They have, when you've got a $100 billion fund, you don't have time to invest it $25 million at a time. So these deals that we're doing, by buyout standards, they're pretty small, but by venture standards, they're pretty big. This is this risk reward disconnect that I mentioned earlier. A really difficult part, and I've been on the entrepreneur side. I've been a startup executive, and I know how time consuming and difficult it is to attract management. And our strategy is to acquire operating companies who have the capable management already in place. What they don't have is this silver bullet or unfair advantage, as we refer to it, that will enable them to rapidly grow their business. We view technology as capital, and ultimately what we believe we're doing is we're putting 2 and 2 together to make 7. Or in the case of that 911 deal, we're turning $12 million into 85. So what do we look for when we're looking for technology? And again, this conversation is, I'm hoping that you guys are thinking about this conversation in the context of how might you get involved in what we're doing, whether you're interested in an internship, or you just know of technology that fits this description that could benefit from what we do, let us know. And we do pay a referral fee for people who introduce us to technology that leads to a deal. And just as an aside, that's a $20,000 referral fee. But in a lot of cases, people who refer us technology, they say, well, I don't want $20,000. I want to participate in the deal. In which case, we'll permit them to participate for $25,000 worth of stock. But in any case, what we're looking for, number one, above all else, is the technology is immediately deployable. It needs no further time or money or regulatory approval in order to be deployed. It is turnkey technology. Number two, we're looking for this technology that is, underutilized or languishing or dormant someplace. Maybe it's even been abandoned. 5 years ago, somebody developed some technology and maybe gained some early traction before they hit the wall and just, shelved it and moved on with their life. There's a lot of technology that is just sitting on the shelf, gathering dust, waiting to be discovered. And not most importantly, but very importantly, is the acquisition landscape. Can this technology be deployed into an industry that's populated by a lot of undifferentiated competitors so that we have numerous acquisition targets to choose from and to negotiate with? So again, I'm not going to read you the whole slide here. We can come back if you have questions, but we're looking for technology that's ready, it's languishing, and it can enable us to drive growth in companies that are otherwise just sort of, what we used to call also-rans, right? So they're just another competitor with no particular advantage. So I don't know what time it is. I've tried to talk faster than I did the last time. I'm 25 minutes into this, so I think I'm ahead of schedule. But the logical question might be, well, where does this fit into a career trajectory for a PhD, and how might TCP's Technology Capital Partners internship be of assistance to you in that regard? And clearly the punchline is all about making yourself indispensable, but I'll address that first question first. And that is that, people that are in private equity often come from industry. So they might be experts in retail, or they might be experts in diesel fuel, or they might be experts in software, but they're typically experts in the business, not in the technology. And they often need help locating and evaluating a technology to conclude, yes, this is the most compelling technology in a space, in order that they might invest. If they're a venture capitalist, they would invest in the technology as I've described to you before, that's not what we do. We don't invest in technology. We invest the technology in acquisitions. So we're looking for something very specific. And we've had PhDs work with us from UC Irvine. And we also have, I'll describe this. This internship program started when we launched it at USC in 2019. And we launched it with a couple of MBAs from USC's Marshall program. These are MBA candidates. And we teamed them up with a couple PhD candidates out of USC. And they worked very successfully together and very effectively. So when I was describing, I was at a meeting at Beale Applied Innovation before Harinder and I met. And when I described what we're doing and how we're doing it and how we're teaming up with interns from USC, they said, well, why don't you come do that here? That would be an awesome learning experience for our PhDs. And it would expose them to a realm of business and finance and private equity and investing that you don't typically get to, experience. And that's the reason we're having this conversation is to cover a lot of ground, tell you that we're looking for interns. In fact, I was on a call this morning with the gentleman who runs the engineering school at UCI, because we're also looking for engineering graduate students who might be interested in interning with us. And so let me see, I think that may be, yeah. I mean, we've got other, appendices. Oh, by the way, this is that, whoever asked the question about an example, this is the example of that 911 deal. It was a $30 million deal with a $12 million equity investment. We put together the only manufacturer of digital switches for the 911 industry with a state-of-the-art 911 software for managing the emergency. And then it was actually 85 million. It was, we sold it to Golden Gate Capital 5 years later. So our investors made 7 times their money with what we maintain is a much reduced than usual risk profile. So so here's some examples of technologies we're looking at. Here's describing the strategy. This is sort of repetitive. There's our team, and I'll back up here, but I think it'll let me back up. So I know I went through this very fast and I covered a lot of ground, but Harinder, did anyone have any questions that they submitted to the Q&A box that you'd like me to address?
No, I don't see anything, but again, reminder, if you have questions, you can either type in the chat or feel free to unmute yourself.
Okay, and actually, since this is intended to be more conversational, I don't know exactly what the mechanics are of using this software, but if you have a question about any of this, a logical question might be, why should you care? I mean, and I'm happy to talk about that. I think you should care. I think this is an extremely, and by the way, I don't know how much experience you guys have in private equity and venture capital, but Mitt Romney, who used to run Bain Capital, this is how he became a billionaire. So there's a lot of money to be made. There's a lot of value to be created. There are a lot of jobs to be created. And this is a place where a PhD can make themselves indispensable if they know that this exists, right? And that's the whole purpose of this call.
Great. Michael, there's one question. The person wants to know more about the internship program as to what it would entail, what kind of job responsibilities. And I think the person is from biomedical background. They just want to see how they can apply their experience and what they do. I mean, of course, it's going to be a totally different kind of work. But do you think they might be they're equipped or trained enough to be part of the internship?
Well, yeah, that's a very good question. Thank you for asking that. It's important to this conversation. So what we did at USC originally was we teamed up an MBA candidate with a PhD candidate, and we had them work together as a team. And their objective is to source technology out of the broader USC ecosystem, right? It might be technology that is already, resides within USC, or it might be a technology that, a couple of years ago spun out and formed a startup. Maybe they raised some capital, maybe they got some early traction, and then people talk about the valley of death when they're talking about technology, and that's a very common thing. And so, again, there's a vast quantity of technology out there that is, I hate to use the word desperate, but they've done everything right. The technology works, it's compelling, it's disruptive, it does everything, and yet the venture community just doesn't care because it's never going to be $1 billion exit, which is what they're all looking for, right? so what we do is we take somebody, an MBA candidate who has more of a business and finance mentality, and we take a PhD candidate who has a more of a technical mentality, and we team them up to source technology out of their university. So here, the job, we have an MBA. He's not an MBA. He's a master's in finance, who's one of our interns at UCI right now. He's a very smart guy. And we're looking for a teammate to partner up with him to source technology from within the UCI ecosystem, broadly defined, right? The obvious place where you might look would be within the technology transfer offices, or an engineering professor that you know, or your advisor or entrepreneurs in Orange County who are UCI graduates and the technology was developed there. So the task is to locate technology that looks like what I described, and then evaluate it, both from a business perspective, which is the purpose of the MBA or the finance masters, as well as from a technical perspective. And the expectation is that this will expose technically minded people to business concepts and finance concepts and private equity concepts. And they'll take business and finance oriented people and expose them to how do you evaluate technology, right? So that's the team. And we're actually looking to have two teams on each campus. And as an example, we had an MBA candidate at USC who was doing what I'm describing, working with one of our PhDs, and then a venture capital firm came along and stole him away. And they stole him away because he knew what he was talking about, because he was interning with us and he had something interesting to describe and experience that he wouldn't have otherwise had. So again, to answer your question, the job of the interns is to locate and evaluate technology, and then surface technology that lends itself to what we do. Harinder, was that clear?
Yeah. I think another follow-up question is slightly on those lines, that what are some of the key skills that PhD students bring into these internships that you're looking for? And I believe the question maybe is more towards if you're pairing a PhD with a finance student, then PhDs are really good at literature search, identifying the market, what's the gap in the market, and things like that. So can you elaborate a little bit more on that?
Yeah, that's exactly it. It's
okay.
We're looking for really smart people who come from a technological background, and they have relationships with other people from technological backgrounds who they can talk to sort of canvas about some area of technology that may not be their focus of their PhD. But yeah, exactly what you said. It's sort of, find the technology and evaluate it from a technical perspective. And that may be right up your alley because we're finding something in nanotech, and that's where you're pursuing your PhD. Or if it's not, somebody who is, right? So the idea is, how do we create leverage in this organization that will, the way you add value to us is you source and evaluate technology that lends itself to what we do. The way we add value to you is we train you. And for instance, every Friday we have a 2:00 call with all of our interns. And we talk about the deals we're working on. We're talking about the technology we've seen. We've talked about the opinions of our PhD at USC and the MBA or the Master's in Finance down at UCI. So it's a team effort to locate and evaluate technology from a business and a technical perspective. And the big question is, will this technology that has maybe been ready for a couple of years and has given up because she for that matter was unable to raise capital because the venture community deemed that it wasn't ever going to be big enough. And the way I describe it is that we're not in the unicorn hunting business. We, Technology Capital Partners, are about more consistently hitting doubles by acquiring a company that's doing 50 million a year in revenue, putting it on a growth trajectory to 200 million, and then selling that to a strategic acquirer for whom we have done all the legwork. Right? I feel like I'm getting a little bit down into the weeds, but I hope that answered that question.
Yeah, for sure. I think there are a couple of questions related to the internship, so I'm going to club them all together. So first question is, how long are the internships? How many hours a week? And are the internships paid? What is the eligibility criteria and how do we apply for it? So the whole package.
Okay. Well, so first of all, they are unpaid. The value of the internship is the educational component and the experience component and the exposure to business concepts that as a PhD you most likely would not otherwise be exposed to. That's the value. That's the reason UCI invited us to come do this at UCI, right? The term is, and not the term, but how long this internship, this is not a summer internship, right? We are looking for PhDs and engineers that can join us tomorrow, right? We've got technologies that we're evaluating and technologies that we're sourcing, and this opportunity is immediate, right? It's not a summer internship. In fact, what we're really interested in is folks who can stay with us for some protracted period, because frankly, it'll take a couple of months for our interns to become able to talk about what we do and why and how, right? There's some training involved here. And what we don't want to do is bring on an intern that we train for 2 months just in time for them to leave, right? So we're particularly interested in sort of younger, not younger age-wise, but newer in their pursuit of their PhD. So maybe they're in their first or second year instead of their last year, and finds this interesting, and we can train them up and they can add value and they can participate. By the way, this isn't just about research. Once we find a technology and identify an acquisition target, this is going to be an opportunity for our interns to participate in the deal all the way through until we acquire a company and integrate the technology. And who knows, in the process, you might be creating an opportunity for yourself to join the company that we acquire, right? Because you know the technology so well and you sourced it, and this is sort of like your idea. And so maybe you join this $50 million business that we acquire, and you are part of the team that will commercialize this technology. In terms of, so that's when and how long, and it's unpaid. And how do you apply? You contact me, and with your resume and your LinkedIn profile, and a short cover letter that tells us why you think this is of interest to you, or not why you think, but why is it of interest to you, and why you think you can be effective in this role. And what else did I not answer, Harinder?
I think you got everything covered. Just one thing, how should they contact you? Do you think it's okay for them to contact you via LinkedIn message? And I'm going to add the LinkedIn URL, your LinkedIn URL in there. Is that fine?
Sure, that's fine. Or you can just go ahead and email me. In fact, my associate, Daniel Wong, who is here in Los Angeles with me, is on this call, and he coordinates our interns. And so you can write me and or him. It's confusing. His first name is actually William, but he goes by Daniel. So it's William Daniel Wong. And it's wdwong@tcp-us.net. So in fact, by the way, that reminds me, if you, now that I've had a chance to introduce this, you might want to go look at our website, which Daniel created. So if you don't like it, you can take it out on him. But the website is www.tcp-us.net. And that will show you who we are and what we do and why we do it. And there is a list of frequently asked questions, all of that stuff. So you might want to check that out and decide if you're interested. And then either through LinkedIn or by emailing us. My email is the same as Daniel's in terms of its structure. It's mfott@tcp-us.net.
Great. I added both the emails in the chat, and I will also be adding the LinkedIn URL so people can, look at it. And I think that might be great if you also contact via LinkedIn. Michael will be able to have a look at your LinkedIn profile and see what's your background instead of if you don't prefer too many emails. So I took care of that, Mike.
Thank you. And what we're looking for is to create a win-win situation here. We're looking for really smart people who can help us locate technology that works for what we do. And the sort of quid pro quo is that we will give you an experience as PhD candidates that you will likely not get anywhere else.
Great. There are a couple of more questions, Mike. They are related to more. Okay. Well, first one is, how do you search for technology companies to invest? Well,
that's a very good question too. The private equity business, the investment business, and the M&A business, mergers and acquisitions, which is really what this is about. This is about acquiring operating companies that we're going to turbocharge by infusing technology. that is a very personal, trust-based business, right? And so it's difficult. It's proven difficult under COVID circumstances to go out there and meet people in person and build a network and establish relationships with sources of technology. But the obvious places where one would look would be in the technology transfer office of a university, or professors in the engineering program or the medical school or wherever. Beal Applied Innovation. Now there's a fellow named Luis Vasquez who was managing all of the investor relationships with Beal Applied Innovation. I believe I saw that he recently left UC Irvine to go do something else. So Beal Applied Innovation is in the business of commercializing technology. In fact, that's the whole point. What I learned from this experience when I was in Princeton was that this universe of technology commercialization is vast. You've got industry associations, you've got technology transfer offices, you've got nonprofits, you've got individual entrepreneurs and technologists and PhDs, and then you've got this vast world of technology that is seeking to commercialize. And by and large, without being disrespectful to anybody, most of the compelling technology that exists never sees the light of day. And it's not because it's not good technology. It's because the standard method of licensing or selling or raising capital for your technology, it hasn't worked. And this strategy of acquiring an existing operating business through which to commercialize the technology. So the mentality here is we're not going to try to convince them to do it. We're going to buy them and do it ourselves, right? So it's a very different mentality. And so, it's funny because when we talk about what we do, people's initial reaction was, wow, that must be difficult to find this technology. And the fact is, it's not. This technology is all over the place. And in fact, we've had some really compelling technology referred to us by UCI Beal. And I won't go into detail on that, but it's a materials technology related to the medical space. So the technology is everywhere, and the mission of our PhD candidate teamed up with our MBA, with our finance masters, is to go scour UCI and figure that out. Where is this stuff, and how do we find it? And remember, it's not just technology that still resides at UCI necessarily. It's technology that maybe spun out of UCI in the past. So this is broader than just the UCI campus. And by the way, for what it's worth, my son graduated from UC Irvine. So, there's a plug. But did that answer the question, Harinder?
Yeah. There's another question about, aside from internships, if someone is looking to break into a role like this, just like, post PhD, I believe the person wants to know what sort of training and how to break into this kind of role. For sure, you need a training. So, but, in terms of more like a career trajectory, training and sort of step one should take to break into a role like yours.
Well, and particularly someone with a technical background, a PhD candidate or an engineering candidate, the most important thing is to understand that it exists and what it is. That's why we're having this call. Right. I'm just trying to pull back the curtain on something that you may not be familiar with. And so number one is to understand what it is and how it works and how your training can be valuable in the context of this industry. Because there are a lot of people who are very seasoned executives and investors who don't know technology, right? They understand it at a high level in terms of its business implications, but they don't understand really how it works. And so the real value for a PhD in the context of a private equity firm or a venture capital firm is that your ability to do what PhDs do, like Harinder was mentioning earlier, research and evaluate and dig and find and have opinions and provide guidance to investors. And again, part of the value of interning with somebody like us is that not only will you get exposure to this industry, you'll get hands-on experience doing what we do. So for instance, we had an MBA at USC. I think maybe I mentioned this already. We trained him all up and he was doing a great job. And then a venture capital firm stole him away from us. And it was like, kind of upsetting, but we consider that a win. It's a win for him and it's a win for us because now we have an ally inside another institutional investor who understands what we do and how we think. So again, the most important thing, if you want to get into this industry, is first of all, read about it and understand about it. And that my objective in this presentation is just to sort of give you a peek. And I flew through the front stuff, right? So, but I just continue to believe that PhDs can be immensely valuable in the context of doing private equity deals, whether they're using our strategy or not, right? I just think that our strategy is pretty compelling.
Great. We have another question. The person wants to know, when being evaluated technically, what kind of measurements you usually look for? In other words, what are some example approaches to measure how much it will worth or benefit from a technical perspective?
Well, that's what we are looking for PhDs to tell us, right? Because you pursue different approaches in different realms of technology. So what you might consider when evaluating one technology, you might consider a completely different set of performance metrics or key indicators for another technology. So that's the expertise that we're looking to bring aboard, and for you guys to do that with us.
So there's another question. I think it's a very broader umbrella kind of question. I love that somebody asked this question, saying that if they were to work, either internships or gain this kind of experience with you, how does that apply? Let's say they decide, okay, well, this is not for me, but for sure it's a great thing that you went through it, right? But how do you think that might be useful for them if a lot of them want to get into biotech and pharma industries, not really research, but then more like product development, business development manager, that kind of roles? How does that apply that can be beneficial?
Well, the most immediate obvious value is that you understand how investors evaluate investment opportunities and how they evaluate technology. So having, if you have more entrepreneurial agenda to go launch your own company or join a big company in the future, this is invaluable experience to understand how private equity investors and venture capitalists evaluate an investment opportunity, in this case, specific technology. So if you're a PhD and you've spent some time in the private equity world, and you want to go work for a big company in their lab or not in their lab, you would be very attractive to them because you bring something that most PhDs don't. You bring this exposure that you have and this understanding of what investors look for in startup companies and in evaluating technology. So the point here, like when I left Wharton and went to Lehman Brothers in investment banking, one of the things I learned was that I didn't really just want to be an investment banker raising money for somebody else or buying a company for somebody else. I wanted to do that for me, right? And so by virtue of the fact that I got that experience and that credibility, I'm now able to do what I just described. But I couldn't have done this if I didn't do that, right? And the combination, in fact, of my background, I went to Lehman Brothers out of Wharton, and then I went to industry. I went to a company called Allied Signal, which it was a $12 billion company. I was director of operations analysis, and over $3 billion of that, I reported directly to the CEO. And then from there, I went to this technology incubator in Princeton that enabled me to identify that there is it's broken. Technology commercialization, in my view, without being disrespectful to anybody, largely is unsuccessful. And that's why there is such a huge opportunity for us and anyone working with us to source technology that is compelling, but struggling to commercialize. And in many cases, it's just dormant. And then we, as I described, our philosophy is to acquire the launch pad through which we commercialize it rather than try to convince them to do it.
Great. There's another question, and that this question came in a direct message, and I'm glad there was a reason why the person wrote in direct message, saying that I can see that your background is not virtual because I can see a dog moving. So it says, if your background is that means I'm really curious to know how much money, how much a financial sort of like incentive is there in private equity and technology commercialized space. Sure. Wonderful question.
Well, as I mentioned earlier, how a limited partnership works is you have a particular realm of expertise and you're working with other partners who maybe a handful, 2 or 3 other individuals that have a realm of expertise, and you raise a fund. You might raise, we have been approached about a $400 million fund, and we're in the midst of discussing whether we even want to do that. But if you do raise a $400 million fund, let's, as an example, you typically have a 2% management fee. So I think that's around $8 million annually to cover your operating costs. So out of that, you can pay your partners a couple $100,000 a year. You can pay your vice presidents 150, your associates 100. I mean, I'm just throwing out numbers. But the key, you're not doing this because of the salary. You're not doing it because the management fee enables you to pay yourself a good income. You're doing it because of the upside of putting together these deals that you're going to be financing and taking control of. So again, I mentioned Mitt Romney. There's many people in the private equity world. He's a billionaire because this is what he did. He was with Bain Capital. And so, it's first of all, you have to but you have to expect that you will be successful, right? In our business model, we want to buy a company that is sort of an undifferentiated, who cares, boring company. And we will pay an undifferentiated, who cares, boring price, right? And we will infuse it with the technology and make it much, much more profitable. And when we've done that, it's no longer sort of an undifferentiated, boring, who cares company. It's now a specialty company. And so where we may be paid 5 times cash flow to acquire it, we will have grown cash flow very rapidly, and we'll sell it at 10 times cash flow exiting. That's what this is all about. This is about taking, in our model, this is about acquiring businesses that are just existing and turbocharging them by infusing the technology that would enable it to do that. And if you buy, the way we describe it very simply is that we buy small cash flows at a discount and we sell big cash flows at a premium. And if you do that, and if you're successful doing that, there is a lot of money to be made. I don't know if that answered the question, but yeah. I think that's what he was getting at.
Yeah. And I think, there's a perfect segue question to what you just described about, getting the technology, which is just sitting out there and not being used. Now, the question is really how much of an idea would you ideally have? I guess, once you identify that, okay, this is a technology which is sitting there, could be really impactful. How much is that worth? Is there a way, a scale by which you measure that, how much this is going to grow and you can benefit, and technology can become really, really big in future? How do you estimate that so that it's not just a waste of money for you?
Yeah. So I'll give you an example. We met with an entrepreneur who had a nanotechnology, and he was working with NASA to create materials using this nanotechnology that was important for, space travel and the International Space Station and all those things. But this nanotechnology had other use cases. So what we asked that technologist initially, this was a technologist / entrepreneur. He was both a technology person and a business person. And we said, okay, well, what do we buy with this technology? Taking everything that you've told us about it at face value, what would we acquire? And at first he looked at me like I was crazy. And he goes, what are you talking about? I'm trying to raise money. I don't have anything to buy anything with. And we go, no. We go, no, you're missing the point. You've got the technology capital that can be can be invested into a company that we acquire, and we can achieve 3 things simultaneously. We can accelerate and de-risk the commercialization of your technology. We can give the company that we acquire an unfair advantage, and we can create unfair or proprietary deal flow for ourselves where we're acquiring. Because if you think about it, we're looking for technology that's dormant somewhere, right? To acquire companies no one else wants to buy. And then we put these 2 things together and create an explosive growth combination. So when we meet with a technologist who has a technology that fits our profile, the first question we always ask is, where's the low-hanging fruit? What do we acquire where the infusion of this technology would immediately unfairly advantage that product or service that they deliver? And in the case of that nanotech, we went immediately into water filtration and particularly industrial water filtration and fracking water and filtration membranes that were enabled to filter out things because of this nanotechnology that you couldn't otherwise filter out. So did that answer your question, Harinder?
Yeah, I think the person again has a follow-up question also, which I think will tie into what sort of you were getting at. Is What's an upside to a worst case scenario? Let's say you acquire something and that just like really, really fails. Is there something you still get out of it?
Yeah,
and not
sure.
yeah.
Exactly. That's a really good question, because if you think about it, and that's why we do what we do. When you're a venture investor, you're going to give $10 million to some individual who tells you they've got this technology and it's proven, but they tell you what they're going to go build. We're going to build a company. We're going to hire all this great management talent. We're going to all these salespeople. We're going to have all these customers and everything. And it's like, okay, well, have you ever done that before? Right. And in a lot of cases, well, no, I've never done it before, but I'm going to assemble a team and we're going to like really rock the world by building something. Well, in our model, and that's a very risky thing to do, right? Because if they fail to do that, then this venture capitalist has just invested $10 million that has gone to zero, right? In our model, what we're going to do is we're going to acquire an existing operating company that is already profitable. It's only marginally profitable, and it's not the reason we're acquiring it, but we're acquiring it because we can turbocharge its profitability by the infusion of the technology. But if that doesn't work, if we make a mistake and that technology doesn't live up to its potential, worst case, we still own a business, right? A company that has been in business for 10 or 20 or 30 years, and they are a profitable business. So from our perspective and the perspective of the technology, you are coming into a deal where we're not investing in smoke and mirrors. We're not investing in promises. We're investing in technology that has been proven to us works to acquire an existing business that's been around for many years. So that's where the reduced risk proposition comes in. I hope that made sense.
Yeah, great. There's another follow-up. When you just mentioned technology infusion or turbocharge, the person wants to know, is that the vertical integration?
Well, no, it's not vertical integration. It's integration of that technology. Let's say you've got a company that manufactures a product, or you've got a company, for instance, here's an example. Let's say there's a company that does environmental reports, right? They do environmental testing. They sample core sites at gas stations that are largely, polluted. And so here's a consulting company that charges by the hour to provide research reports on a prospective site that someone wants to acquire. If you could instead do that with software, you could convert an hourly based consulting business into a SaaS business, and you could very rapidly sell your service to customers that you don't have today, and you can charge a premium for that because it's extremely valuable. And so that's an example of acquiring a company that does the same thing everybody else does, in this case, in environmental remediation consulting, and you're going to turbocharge it by infusing this software that will enable them to collect these samples and track these samples. And it's something called, I forget the word, provenance, I think is the word. It's like you can keep track of the samples, and in any case, you're converting an hourly based business into a SaaS business. And that's an example of something we're looking at right now.
Okay, I think we still have 2 minutes. There's one last question, and I totally agree with this question. So the person wants to know, I have a biomedical background, but all what you're talking is like alien and new, but then I'm really understanding and I'm really getting interested in doing this kind of stuff. But how much of patience you're going to have if I'm like still like sort of like learning the ropes and trying to get used to the internship?
That's what we expect. That's, so when we look for MBA candidates to be interns, we're interested in finding somebody that has a finance and private equity and investment banking background, because they have a lot of that skill set that our PhDs or our engineers don't, right? But they don't have the skill set that our PhDs have, right? So that's why we're trying to put these teams together where a technically minded person learns from a business minded person and vice versa. Right. So when we're talking about a PhD candidate, we're not expecting that somebody's going to walk in the door and understand the private equity world and how it works. And that's why we're doing this internship, is that's the value that we can provide. Now, in exchange, I know what I forgot to answer. One of the questions was, what kind of time commitment is this? And basically what we're looking for is, and it varies. It's kind of spiky. Sometimes you're very busy, sometimes it's quiet. But I think a fair number to sort of expect would be, maybe 6 hours a week kind of workload. In some cases, it's 10 hours, and in other cases, it's 0. It just sort of depends on what we have going on.
Awesome. Well, great. Thank you very much, Michael. It was a pleasure having you. And look, I mean, we really enjoy working with you and looking forward to seeing you again or having some of our folks working with you in the future.
Hopefully in person sometime soon.
All right. Thank you very much.